Hey everyone, and welcome back to the channel. Today, we're diving into the backbone of the global financial system. Two companies you might not think about every day, but they are absolutely essential. S&P Global, ticker SPGI, and Moody's Corporation, ticker MCO. Think of them as the unsung heroes, the vital plumbing that keeps trillions of dollars flowing in capital markets. We're going to break down what makes them tick, why they're such powerful businesses, and what you should consider if you're looking to invest. Section 1. The foundation. What do they actually do? Visual aid suggestion. Animated graphic showing money flowing through pipes, with SPGI and MCO as gatekeepers. So what exactly do S&P Global and Moody's do? In simple terms, they provide mission-critical information that the financial world can't live without. Their most famous job? Credit ratings. On-screen text. What are credit ratings? A grade on a company's ability to pay back debt. When a company or even a country wants to borrow money, investors want to know if they'll get paid back. S&P and Moody's give them a grade, like a credit score for businesses. This is so crucial that institutional investors often require ratings from both S&P and Moody's before they even consider buying debt. This gives these companies immense power, almost like a duopoly in the ratings world. But that's not all. S&P Global, SPGI, the diversified data powerhouse. Visual aid suggestion. Infographic showing S&P Global's 5 segments with simple icons. S&P Global has broadened its reach. They're not just about ratings. 1. Ratings. Their core, giving credit scores. 2. Market intelligence, providing vital data and analytics platforms, like Capital IQ Pro, often subscription-based. Think of it as a superpowered Bloomberg terminal for analysts. 3. Indices. This is huge. They own the world's most famous benchmarks, like the S&P 500. Every time you invest in an ETF or mutual fund tracking the S&P 500, S&P Global gets a small fee. That's a powerful network effect. 4. Commodity insights. Platts. They literally set prices for global energy and metals. If you're trading oil, gas, or metals, you're likely using a Platts price as your reference. It's like a toll booth for global trade. 5. Mobility. This segment, focused on automotive analytics, is actually being spun off in mid-2026. This move aims to sharpen S&P's focus on its higher-margin financial data. Moody's Corporation, MCO, the focused risk expert. Visual aid suggestion. Infographic showing Moody's 2 segments. Moody's, while also a ratings giant, has a slightly more focused approach. 1. Moody's Investor Service, MIS. This is their ratings agency, very similar to S&P's ratings division. 2. Moody's Analytics, MA. This provides subscription-based risk management software and data. They help financial institutions understand and manage complex risks, boasting an impressive 68 consecutive quarters of revenue growth. Section 2. The Money Talk. Financial performance and dividends. Visual aid suggestion. Simple bar chart showing revenue growth for SPGI and MCO over recent years. These aren't fly-by-night operations. Both companies are incredibly profitable and resilient. The last few years have been a roller coaster. A pandemic, ultra-low interest rates, then rapidly rising rates. Both weathered the storm. Revenue and profitability. S&P Global's revenue has been boosted by big acquisitions, like the IHS Markit merger in 2022. They hit over $14 billion in revenue in 2024. Moody's, while smaller at $7.1 billion in 2024, has seen strong organic growth, rating over $6 trillion of debt that year. On-screen text. High operating margins. 50% plus. Their operating margins are among the highest in the financial sector, often exceeding 50%. Why? because their business relies on intellectual property and data, not expensive physical assets. Once the systems are built, additional revenue often drops straight to the bottom line, a true toll booth model. Dividends. Rewarding shareholders. Visual aid suggestion. Split screen with SPGI Dividend Aristocrat Badge and MCO Dividend Contender Badge. Both companies are committed to returning cash to shareholders through consistent dividends and share buybacks. S&P Global, SPGI the Dividend Aristocrat. This is a big deal. S&P Global has increased its dividend for 52 consecutive years, making it one of a tiny handful of companies in the S&P 500 with such a track record. It means incredible stability. They have a conservative payout ratio of about 22%, leaving plenty of room for future growth. Moody's, MCO the Dividend Contender. While not an aristocrat yet, Moody's has an impressive 17 years of consecutive dividend growth, and its dividend has actually grown faster than S&P's in recent years. Their payout ratio is also very safe, around 26 to 30%. Section 3. Their unbeatable edge. The moat. Visual aid suggestion. Castle with a deep moat, labeled SPGI and MCO. What makes these companies so powerful and hard to disrupt? It's all about their moat, their competitive advantage. 1. The credit rating duopoly. As we mentioned, most institutional investors need S&P and Moody's ratings. It's a self-reinforcing system. If you want your debt to be marketable, you have to go to them. 2. Index dominance. The S&P 500 brand is synonymous with the U.S. economy. This gives S&P Global enormous pricing power when licensing its indices. 3. Commodity price reporting. S&P Global's Platts is the undisputed leader in setting prices for global energy and metals. These aren't just suggestions. They are the standard references for trillions in transactions. Switching providers is simply too risky for market participants. These are not easily replicated businesses. The trust, the regulatory integration, and the deep-seated network effects mean new entrants face extremely high barriers. Section 4. What's next? Future growth and risks. Visual aid suggestion. Dynamic graphic with growth drivers, arrows up, private markets, ESG, AI, and key risks, arrows down, macro, spin-off, regulatory. Even the most dominant companies face evolution and challenges. Future growth drivers. Private markets. As traditional banking lending shifts, private credit and equity are booming. Both S&P and Moody's are moving in to provide data and transparency in this rapidly growing space. ESG, environmental, social governance. This isn't just a buzzword anymore. It's a regulatory requirement. Both companies are integrating ESG scores into their ratings and data, helping investors and companies navigate the transition to a low-carbon economy. Artificial intelligence, AI is a game changer. They're using it internally to automate tasks and boost margins, and externally to create new, powerful research tools for their clients. While some fear AI could disrupt them, experts argue their branded trust and regulatory standing are too strong for AI to easily replicate. Key risks to watch out for. Macroeconomic sensitivity. While their data businesses are stable, their ratings revenue is tied to the volume of debt issuance. If the economy slows and companies borrow less, ratings revenue can take a hit. This was a factor in S&P Global's recent stock dip in early 2026. Spin-off risk. S&P Global's plan to spin off its mobility division in mid-2026 carries some execution risk. Losing that revenue and potential synergies could temporarily impact valuation. Regulatory and reputation risk. These companies are constantly under scrutiny. Any major rating failures, like during the 2008 crisis or cybersecurity breaches could lead to fines and a loss of trust, which is their most valuable asset. Section 5. The takeaway: SPGI versus MCO for investors. Visual aid suggestion. Side-by-side comparison table of SPGI versus MCO. Key investor factors: diversification, dividend, growth, ROE. So which one is for you? Both are high-quality companies, but they cater to slightly different investor profiles. S&P Global, SPGI: the diversified, stable aristocrat. If you're a conservative investor looking for broad exposure to financial data, consistent dividends from a dividend aristocrat, and diversification across indices, commodities, and market intelligence, SPGI might be your pick. It's a larger, more established data conglomerate. The recent stock correction might even offer a rare entry point into this wide-moat franchise. Moody's Corporation, MCO: the focused, efficient growth play. If you want a more concentrated bet on the credit cycle and high-end risk technology, Moody's offers higher dividend growth and superior return on equity, due to how they manage their capital. It's a more efficient capital compounding machine, though with slightly more revenue concentration in ratings. Ultimately, both S&P Global and Moody's are poised to benefit from long-term trends like private credit growth, ESG integration, and AI innovation. They are the essential infrastructure of global finance. Call to action: don't just take our word for it. Always do your own thorough research. Have you invested in SPGI or MCO? Let us know your thoughts in the comments below. If you found this breakdown helpful, please hit that like button, subscribe, and ring the bell for more insights into the financial world. Thanks for watching, and we'll see you in the next one.